recommend it to parents teaching their children. I would recommend it to grandparents. If you really trust in their system, you will do well.
For more information, go to philsgang.com or give us a call at 877-600-4264.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grande and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, or you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now that can be really expensive, cost thousands of dollars, but I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro, Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye.
Good afternoon. Okay, welcome to the Big Bubble. Okay, so it's interesting how up to this point, no one's been talking about the AI bubble, meaning the bubble driven by margin debt. And it's the margin debt that we've never seen. I mean, this is incredible, the amount of money, $1.1 trillion. That's what's been driving the stock market. Now, that's not good. But even though it's been, I mean, again, when you think about it, these past 7 months, since April to October, there has been, let's use October, okay, the end of October. There has been a massive 30 billion, okay, in AI tech stock dumps. What I'm trying to say is the big institutions, the pension funds, the wealth funds, the hedge funds, the insurers, the biggest banks, they have dumped 30 billion in the AI tech sector. That's huge, but we don't hear about it. I mean, that's big, but we don't hear about it. The reason is that these AI stock prices, okay, are higher than their earnings. They're not going to tell us that. Let's think about this. We got the institutions who make all the money, the smartest money. They're called the smart money. And when you talk institutions, again, you're talking the smart money, pension funds, hedge funds, wealth funds, insurers. They're huge insurers. And you have credit unions. I mean, these are managed by very, very smart people, not like Powell. These are dope. These are brilliant people. And so in 7 months, they have realized, man, this is nuts. These stocks are crazy. The stock prices are being pumped up so much that they're higher than earnings. Can you imagine? So they said, let's dump this stuff. And I remember the first time in April when there was talk of this, they were dumping. But no, everybody kept it down, played it down. You didn't hear it on CNBC. You didn't hear it on Fox Business. You didn't, they didn't put any, because they didn't want you to know this. Because everybody would have dumped. Who wouldn't have? So the stock prices being higher in earnings is a death sentence. And so if you don't have your stocks aligning with their valuations, you're really screwed at some point. But the buying never stops, because as they're dumping this historic amount of 30 billion, you got the FOMOs who are in there, as I call them, tourist traders, don't know what they're doing. They're in there buying the stocks right away. Boom. You see the market come down a little bit, the institutions are dumping, boom, they go right back up. So every time you saw a dip, boom, they go right back up. No hesitation, because the FOMOs are in there, using credit card money. Think of it that way, credit card money. I mean, that's really what it is. A margin account is like, they think of it as a credit card. So, but the masking is where the danger is. When these institutions dumped, as these stock prices were higher than earnings, and the FOMOs jumped right in, because they always fear they're missing out. Always fear they're missing out. That's why they call them FOMOs. And the problem is they're borrowing money on margin. Now, margin debt, if you don't understand what that is money investors borrow from brokers to buy more stocks. Now get this, more stocks than they can afford with their own cash. So if you buy 500 shares and you're all hepped up on NVIDIA, I got to get in before it gets higher, So they'll just go borrow money on a margin account because they can't afford the stock. So think about that. We have all these people borrowing money or buying stocks they can't afford, and it's think of it as a credit card. 1.1 trillion. That is huge. That's more than the other three crashes. Right before all the other crashes we had, we never got to this kind of a level. So, as I say, think of it as a credit card, and then you can think of how bad this is, because nobody even thinks about this. So right now, as I say, this is a huge red flag, and they're playing it down. Now, remember, just to try to put it in perspective, this margin debt, this is record. This is much higher than the 2000 peak or the 2007 peak or the 2021 peak. Surpasses all of those record margin debts back in 2000, 2007, 2021. So, in the last 2 weeks, think about this. In these last 2 weeks, do you notice how every day market's making a new high, market's making a new high? I mean, everybody yawns. It's just going to make a new high. Just another one. It's number 54, number 64. Nobody can even keep track of it. Go try to Google up how many new highs there are. You get different numbers everywhere. They can't keep track of it. But nobody cares. So everybody feels they're really, really wealthy now. So now this margin debt, during the past 2 weeks, as we're hitting all these new highs, if you look at it, it was because the margin debt increased by 18%. So the only reason the stocks were going up, making new highs, is because the folks are out there who don't know what they're doing, who are buying stocks they can't afford, and their debt went up 18%. What are you, nuts? Now, to justify this, and why you don't hear anybody talking about this, is they lie to us and tell us how good earnings are. What? Listen to this. This is unbelievable.
This is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that. So,
ever notice before every crash they always say it's different? This is different. As soon as you hear that, it's different. Get ready to start shorting. Get ready to start shorting, or start looking for your sell signals to get shorting. Oh, it's different this time.
this is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that. So if you go back to the 90s and the .com, these are ideas rather than companies, and so there's a clear bubble there. Whereas
oh, stop! He's stumbling around because he knows he's lying because earnings are not good. if earnings were good, all right, let's think of it this way here. So why the stock valuations right now, the popular tech stock, the prices are not keeping pace with our valuation. We talked a little bit about this yesterday. In other words, the stock prices are higher than earnings. You know how bad that is? And these FOMOs are in there buying every minute they can. So the stock price, when your stock price, if you own a stock, that's bad enough if it doesn't align with the valuations. But if you borrowed money to buy that stock, it's not aligning with your valuations. You're screwed at some point. But see, they'll lie to you. See, Powell should be saying, do you realize earnings suck? That's what they should be saying. Do you realize all these AI stocks that they come out and promote every day and just keep going up and up and up? Their earnings. They don't have the earnings. They don't have the earnings. The stock price is much higher than earnings. Well, he won't say that because he knows the market would collapse.
You know, if you look at overall corporate earnings, they continue to be very strong.
There you go again. Lying again to you. Corporate earnings are very strong. How can corporate earnings be strong when it's a fact? When it's a fact that the stock price is higher than the company's earnings. I'm talking about the top 7, 8, 10 stocks. All this AI crap.
And at the end of the day, the consumer looks immensely strong.
There's another lie. The consumer's immensely strong. Are you nuts? Why do you think New York went communist? They just hired voted in a mayor. What's his name? Salami Mahami? Salami Mahami Dadami. He's a communist. He's a Marxist. Because people are so desperate. They just don't feel good. They're turning to, they did this in Cuba. They did this, you know this, North Korea. They did it in Venezuela. They always turn to communism. That's what they're doing now. So if you think New York, the financial capital of the world, would have gone communist? How could the financial capital of the world go, and they decide to go to Marxist, to communism? You think the people feel good? Boy, at New York, are they going to get a lesson and a half, right? You watch. In about a year, they'll be trying to throw this guy out. What a dope he is. So going back to our problems with margin debts, you got to be prepared. You better learn how to sell short. I'm not trying to scare you. Traders believe the lies. That's the problem. And as I said, if you take the 2 weeks that we had just recently, going up every day, new highs, new highs, new highs, it was only because they were borrowing more money, increasing the debt. Because the FOMOs, right? They want to get in. They're scared they're not going to get in time. Now, what's important to watch is the sell-offs. I told my gang members today, if you go back and look, every time NVIDIA would sell off, or Micron Technology, I'm talking about the top semiconductor stocks, they'd come right back because the tourist investor, the FOMO, he'd go right away and cash his credit card, I'll buy those stocks for you. I mean, imagine these people are so dumb. They're saying, they'll say to an institution, oh, you selling your stock? Let me have it. Institutions, they have the biggest brain power. I mean, the worst thing about 401ks, you got screwed into a 401k because you got a dope managing your 401k. When you had a pension, you had brain power. And he didn't work on a salary. These guys were smart. Well, you don't think these guys that run pension funds are smart? What do you think they started to dump in April? But they've been able to mask it. Every time they dump the stocks, there's Powell getting more money supply, calling Treasury, hey, pump more money, need more money, need more money. We got to we'll take the money, we'll put it into stock buybacks, we'll give it to the CEOs, we'll take more money. And he calls Wall Street. Hey, Jamie Dimon, put more money. We're going to keep putting more money in your margin accounts. Keep those margin accounts going. We got to keep the stock market up. That's what's going on, all right? So 1.13 trillion, that's bigger than 2000, 2007, 2020, all that. Now remember, margin debt aligns itself with euphoria. When you put this margin debt, what does this do? The first thing, when you keep borrowing and borrowing, you also see NVIDIA, right? Or you see the Qs keep going up every day, or the MAGs. I mean, think about it. It's amazing. If you go back and see, oh my God, my stock back here in November 2023, my MAG stock, okay, was at 31 bucks. I doubled my money at 66. Where's my credit card? Where's my margin credit card? So you go from $30 to $66. So all of a sudden you're in this space of euphoria, and all it is leveraging the peaks. In 2001, the dot-com burst, right? Shortly after it, margin debt levels spiked, and the spiders went down 50%, and NASDAQ went down 70%. Same thing happened in 2008 with the spiders, right? The housing financial crash. Spiders went down 57%, NASDAQ went down 56%. Why? The same thing, margin debt. As soon as the margin debt, you get a fracture, then you get a notice. Hey, you get an email or a call and telling you, you got to send me a check for $25,000. They go, no, just sell my stock. Sell my stock.
9, 8,
so
11,
that's what happened.
5.
So why are we going to be so lucky it's not going to happen now when we're worse off now than in 1929 with margin debt? More when I come back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grande and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now that can be really expensive, cost thousands of dollars. But I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro. Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And welcome back to Phil's Gang. The thing you need to look at is this. You go back and take a look at, let's go to the spiders, and look how when the spiders dipped from August say Thursday, August 14th, pulled back a little bit, then bam, went right back up. Next pullback, same thing, right? That was on August 29th. Bam, came back, pulled right back up, back up. But look what's happened since October 10th. We had the pullback, but it wasn't bang right back up, was it? No. And this recent pullback we just had, when we peaked here in October 23, pulled back. It tried to go back up, make a new high. It stopped at, I think it was around that time, it stopped at the high when it was on its way back up. It stopped at around 685. It couldn't get back to the, let's see, I think it was what was it? Yeah, I think the high at that date there was around 685. And it was struggling to get back to the high around 689, something like that. I can't see it, 680, 688. My point is that the mask is starting to come off. Nobody has a clue because nobody wants to talk about how bad the margin debt is and how fast this margin debt accelerated. It's out. You remember 1929 collapsed because of margin debt. Margin debt. Margin debt's a serious thing. And if you go look at our other crashes, 2000, 2008 to 2020, it's always margin debt, starts getting a hairline crack, starts cracking big, and then bam, your market goes down. That's where we are right now. Now, I'm not saying don't stone me. I don't want to be stoned again. Don't stone me because I'm saying we could possibly have a crash. Nobody wants to hear that anymore. Okay, what they want to hear, even if they think a crash is coming, an adjustment. Everybody's using now the word an adjustment. There may be an adjustment. Let me tell you something. For all these people who want to stone you when you say you might have a correction or crash, margin debt has never been higher than where it is now. And it's never ended well. It didn't ever end with 1929, 2000, never ends well when people are buying stocks they can't afford. People are buying stocks they have to borrow money. $1 trillion? What are you, nuts? So this is very severe. Now, we have never borrowed this kind of money. So if the sentiment starts turning, and it will, don't get mad at me, it will. But here's what I think will happen first. Liquidity is going to tighten. And then the leverage they have right now, all these stocks, will unwind so fast, it'll make that crash in 2000, 2001, 2008, 2020, it'll feel like a gnat bothering you right around your head. You know when these gnats go around your head, feel like, God, just a gnat. This thing is going to feel like your head is in the middle of a shark's mouth. Because we never had leverage like this. So the thing you should be looking at right now is follow. Well, the first thing you should do, if you don't know how to sell short, you better learn how to sell short, okay? And we can help you with that. We've been teaching folks how to go long and sell short since 1998. So we've been doing it a long time. And 90% of people don't know how to sell a stock short. They just sit there and get clobbered. That's why history shows you 90% of the people in the stock market lose money. And the biggest cause is these FOMOs. They always start the crashes because the smart money, the institutional money, they always make money through, in other words, Goldman Sachs, Morgan Stanley, JP Morgan, they compete for this business. They compete, okay, for the teachers fund. They compete for the construction workers fund, the fire department fund. They compete. They got to perform. So they'll do anything to make sure they don't lose money. When a crash occurs, they're already out. They're gone. And that's why in the last 2 weeks, we saw such a surge of 18%. And like I told my members, when you see that, that's when you start selling into that rally. Because what they do is the big JP Morgan, Morgan Stanley, the 5 biggest institutions, they go after the big whale clients, right? Like the California Labor Department, right? That's huge. If you get that pension, you got to score, okay? So what's happened is we're starting to see now that they're pushing the market higher. They're going to push this market higher. I may be wrong if I'm right. In this market, by the way, you're never wrong or you're never right. The only time you're always going to be wrong is if you don't know how to short. You never can make money in the stock market consistently. You always lose. You always lose. Even if your 401k's chock full of money and you feel good and you throw, it comes in the mail, how much is in your 401k, you don't even look at it anymore. You just throw it in your drawer, then boom, you lose it all, just like 2008, right? So when you start seeing all of a sudden a rally, you always get this one last rally. And if you see the rally going up and you start seeing the money supply pulling back, you know that we're heading for a correction. Because the only thing that keeps the stocks going up is your money supply and keeping up the margin debt where they can chuck all that money towards the Wall Street guys so they can have their margin debts always filled with money so the FOMOs can buy. But as soon as you start seeing, here, the yields, let's talk about the yields. Yields are going up right now. Now, when I say up right now, I'm not talking today, but if you look at the trend on yields, this is another thing you have to watch. Okay, if you look at the yields on the 10-year Treasury yield, we've been in an uptrend on the yields as of late. You can see it right here. Okay, now it's down for the day, but the trend, you can see the trend has been as of late has been turning. Matter of fact, if you look at the trend, we had let me see if I can get this for you. We had back here. Okay, we were at a low around October 21st. We were at a low around 3.94. And we got to a high up here about just a little bit over 415. Now we're at 408. So as those yields are going up, that means that interest rates are going up. That means people are shifting to value stocks. That's why you're starting to see the banks here, for example. That's why you're starting to see people move out of tech stocks and they're moving out of growth stocks. They're moving into value stocks. And I was just going over this with my members a minute ago, before my podcast, showing them, look how the banks are going up. But we knew that, right? We knew before that was going to happen, and we stayed on top of it. So our banks, let me get them here so you can see, look at this, watch. So Citibank, you see how it's got relative strength today? So you got the Dow down, 247, and you got the S&P down 47, and you can see that people are they're shifting money to value stocks. Look at this here. Look at JP Morgan. That's ready to take out the high of September 29th. Remember, these were all coming down. Do you remember the day we had bank earnings? And I said to everybody, don't buy, sell into the earnings, sell it. They're lying to you, sell into the earnings. And what happened? They all sold off about 2 days later, remember? And they've been scrambling, trying to get back to that October 10th high. But a few banks, again, are showing relative strength. Bank of America, that could break out. But my point is, there's a shift of money. When you see yields going up, that means there's a shift of money going on. And the money is coming out of the growth stocks going into the value stocks. So what you want to look for are stocks like on a day like today that what we call have relative strength, okay, and that haven't gone down today, okay, that have been either holding or going up.
5 minutes.
And for example, we've been watching today. Let's see. which ones here we had the relative, like Google, for example. Okay, Google has relative strength. Look how it's going up today. It looks good. That could be a good breakout stock. That's what you got to look for right now. You got to look for stocks on down days that are going up, that didn't go down. And there's only very few of them, okay? Micron Technology, that's another one of our stocks we own. And look at that. Look how beautiful that stock's going up when the market's going down. So you got to start looking for relative strength. And then the other thing you got to go and look for, just put up the Qs. And when you see, if you go back and take a look at October 10th, and you see how we pulled back, and normally it goes right back up in about 2-3 days, right? Usually it goes right back up 2-3 days, maybe 4 days, it goes right back to its peak. Here, let's give you an example. We had a peak here of in August 28th. That was on Thursday. It dropped Friday, dropped Monday. And then it went right back up to that peak. It only took, 3 days to get back. 3 days to get back. Here's another one, same thing. It pulled back, okay, and then to get back, it was on a high, and I'm watching the Qs. It was on the high September 23. It was at 602.57. It pulled back in 2 days. It pulled back to a low of around 588.50. But here's the point. It only took it took about 2 days to get back to its peak. So you got to start watching these. Now, if you look and you go back and you're watching the Qs, this is going to be very, very important. Or watch the Qs, watch mags, okay? So we're at a high on October 10th, okay, of 613. It pulled back to a low of 589. And it took us 6 days to get back. 6. Now look at the one we're in today, the pullback here. It started to pull back October 29th. And it went back, was a high of 637, and it pulled back to a low of 610. So now what you do is watch and see how many days it's going to take to get back to the high. So just take the stock you're in, okay, and just go back and look at the pullbacks. I'm not talking about the big major pullbacks, an average pullback. Every stock has an average pullback. So if your average pullback's 2-3 days, and all of a sudden you're starting to see it's 5-6 days, 7-8 days, 15-20 days, you know what's happening, right? So the bottom line is we should really care about margin debt. It's very important. And nobody's talking about margin debt. I think I'm the only one. I shouldn't say that. I'm sure there is, but I haven't heard anybody yet on Fox or even talking about margin debt, because margin debt's important. We should really care, because margin debt is people are borrowing money because they can't afford the stock. So people are buying stocks they can't afford. You want to be in a market that's making all-time new highs because people are borrowing money to buy stocks they can't afford? What are you, totally nuts? And that's insane. Boy, let's get into this market, man. Look at this. People can't afford stocks, but they're making an all-time new high, so they're borrowing money. And what happens when it starts unwinding? And boy, this will unwind so fast. Faster than 1929, faster than any crash. So that's one reason. And we've never had margin debt at 1.1 trillion. This is an all-time high. And margin debt, again, is like being used as a credit card. But this all started with the lie. The earnings are terrific. Ask my gang. I've been saying, going all the way back to April. I said, the institutions are dumping. There's something that's going on. And it's the earnings. When gold started to take off, that's another thing you look at. When gold starts making new highs, boy, Wall Street tries to suppress, Powell tries to suppress, because it tells you something's wrong. Something's wrong in the market or the economy. It's been right. The valuations are screwy. The stock prices are higher than earnings. And you're going to borrow money to buy more stock. Join my gang. Let me help you learn how to short.
You have been listening to Phil Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.